So everyone, thank you for joining me this morning. This is Dave Bear with PENTalk Retirement Services, and we're going to talk about cash balance plan basics this morning. I want to forewarn everybody, I have been fighting desperately to not get a cold and flu, which is quickly trying to take me over. So if I cough or if I otherwise sound bad on the call, please forgive me. I'm going to do my best to not sound terrible. I've got plenty of green tea going here next to me, so I appreciate it. We're going to go through the title of this session was a tax-advantaged benefit that advisors can provide, and the cash balance plan is probably familiar to most of the folks in the room. We're going to talk about the basics of cash balance plans. We're going to talk a little bit about why it's a great tool for advisors, but mostly we're going to go through a case study. I think that having the context of a case study is going to be probably the most helpful for everybody in attendance. And then we're going to do a little bit of back of the napkin type conversation, in that what I envision is for all of you to be able to be sitting with a plan sponsor, maybe at a lunch. You're out having lunch with a plan sponsor. You're talking about their tax situation and how they'd like to save more for retirement and how they'd like to reduce taxes. And I want you to be able to convey an idea literally on the back of a napkin, so that you don't have to, at that point, have a fancy proposal or a fancy analysis, although we're going to provide you with that anyway at some point in our engagement. But I just want you to be able to, excuse me, have that kind of a conversation with a plan sponsor. And then we'll take questions, and when we do that, we'll be on the last slide that'll just talk a little bit about Pentegra. Questions, if you would, go ahead and submit questions while we're on this. We're going to keep everyone on mute today. You can type in questions, and we'll try to get them to them at the end. And if we run out of time, then we'll come back to those questions, or we'll email you with some answers, or otherwise help you and get you engaged. So what is a defined benefit plan, or what is a cash balance plan? A cash balance plan is a defined benefit plan. And I always like the quirkiness of the Internal Revenue Code, how it reads. And of course, it reads that a defined benefit plan is a plan that provides for individual accounts and benefits based on the amount contributed to the account, gains, losses, forfeitures, income, and expenses. And that's in the Internal Revenue Code 414I. And a defined benefit, a defined benefit plan is a plan that is not a defined contribution plan. Well, what does that mean? I think again, most everyone in the audience knows that a defined benefit plan is one that is targeting a future benefit. We are predetermining what do we want to have at the end of the rainbow, and we're working backwards from that to present day to determine how much we have to fund into the plan and how much the plan has to grow by. But we're all very used to 401ks and profit sharing plans, and we're used to small business owners, entrepreneurs who think in terms of, I'm doing well this year, I can put money in, I don't know how well I'm going to be doing next year, that type of flexibility. So we have to balance that with how we're talking about a retirement plan like a cash balance plan. So it is a defined benefit plan. The difference between a cash balance plan and a traditional defined benefit plan is that a traditional defined benefit plan provides a participant statement every few years that outlines how much monthly benefit that employee might be might be eligible for at retirement. And a cash balance plan creates or illustrates a theoretical account balance instead of a periodic future payment. The theoretical account balance is shown on their statements, and it's often referred to as a paper only or a paper account only, and that's because the actual account assets in the plan trust are not directly tied to any one participant's account. You have to think of them as kind of two separate things. The plan exists. The plan has a trust into which contributions are made, and that hopefully earns, has gains and not too many losses. But the point is that the trust grows, and the theoretical account balance is estimated based on or actuarially derived based on what the participant is anticipated to have in the plan. The account balance is credited each year with a contribution credit, again, that is actuarially determined, and an interest credit dictated by the plan. Well, what does that mean? Well, think of it in these terms. You know, again, in a profit sharing plan, you have an employer who looks at their revenue stream and decides that they can put away X amount of money per year. But in a cash balance plan, we are looking at the population that's covered by the plan, the participants. We're looking at their wages and their ages, and we're looking at their years to retirement, and based on the benefit that's defined in the document, we're calculating how much has to be contributed every year. So it's a different world than a profit sharing plan. Now we've learned to accommodate how business owners think, in that they see their revenues increasing and decreasing on an annual basis, and so we accommodate that in cash balance plans much more easily than we accommodate that in a traditional defined benefit plan. But still, there's not the kind of flexibility that they're used to in a profit sharing plan. On the other hand, there's a lot more contributions that can go into this on a tax deductible basis. And an interest credit dictated by the plan document. Again, that's kind of a different term. We're used to a profit sharing plan where the trust earns whatever the trust earns. Either, excuse me, either the participants make their own decisions, or if it's trustee directed, the trustee of the plan, with the help of you, their advisor, they invest the money and they see the returns in that fashion. But in this instance, we're separating that. We're separating how the plan operates from how the trust grows. And so the plan itself is going to assure the participants that we're targeting this much per year at retirement, or this amount of money at your retirement. We're targeting a contribution each year that reaches that, based on a 3% or a 4% or a 5% interest credit, irregardless of how the trust performs. So from the employer's perspective, the employer makes all the contributions to the plan, and the employer makes all of the investment decisions with your assistance. Earnings to the plan are in the form of an interest credit guaranteed by the plan document. Once again, it's a different concept. The document is saying to each participant, we're targeting a benefit that's going to require X amount of contribution based on Z amount of annual earnings. And if down at the bottom here, I say, what if the trust earns I'm skipping just a little bit. It doesn't mean I'll skip everything. What if the trust earns too much? Well, then the employer can't put as much money into it as they might have anticipated. What if the trust earns too little? Well, then the employer has to put more money into it, because the document is focused on what have we promised to provide. Going backwards here just a little bit, earnings are most often a fixed annual rate. they can be tied, for our purposes today, that's what we're going to talk about when we get into our case study. They can actually be tied to the actual earnings of the trust. That's a complex topic for a different time. But think of it this way. If we are targeting a 3 or a 4 or a 5% annual rate of return on the trust of the plan, then we can easily determine how much money needs to go in. And obviously, the lower the earnings of the actual trust, the more money the employer gets to put in. And that's most often, folks, that's most often the focus of these types of plans. They are very much about the tax-deductible contribution, in as much as they're about the future retirement benefit. So what about from the employee perspective? Well, this is not like their 401k plan. They don't get to put money into this. They don't get to make any investment decisions. Generally, they're not allowed to request any loans or hardship distributions, although those are not prohibited. They're not typically part of a defined benefit or cash balance plan. So why are they great tools for you, for an advisor? Well, we're going to show you in a few minutes that an employer can make large contributions to cash balance retirement plans. The plan can be designed to allow disparity of benefits between owners and non-owners, and between owners for that matter. And what disparity means is very simply, some folks can get more than other folks. And if you're familiar with new comparability profit sharing plans, then it's pretty much the same concept. We are separating people into different rate groups for our testing. We'll talk about rate group testing in a little bit. And we are, excuse me, and in some cases we are averaging employees' ages together. We create disparity when there's a difference between the age of, say, an owner and a non-owner, and when there's a difference between the wage of an owner and a non-owner. And so in a perfect world of cash balance plans where you're trying to get as much to an owner as possible and allow them to control, to the extent that they can, the amount that they give their employees, in a perfect world, all employees would be in their 20s and all owners would be in their 50s, and all owners would make $270,000 or more per year, and all employees would make a lot less than that per year. So you'd have a lot of disparity in age and a lot of disparity in wage. That doesn't always happen, but it also doesn't always need to happen. Pardon my pause there as I take a sip of tea. Older employees have fewer years to save for retirement. Higher paid employees will not receive Social Security benefits on wages above the Social Security wage base. Older non-owner employees can be averaged with younger non-owner employees. Defined benefit plans provide as a basic benefit, provide an income stream at retirement. Think of annuities, and that's the way traditional defined benefit plans operate. Traditional defined benefit plans are not prohibited from allowing lump sum distributions, but it's complicated. It's a complicated calculation for a traditional defined benefit plan to provide a lump sum benefit at normal retirement age. Conversely, cash balance plans provide this very easily and routinely. So given the nature of most retirees today, they seek to roll their money at retirement into an IRA with the help of you, their advisor, and then you help them manage that income stream. So cash balance plans are much more conducive to doing that. Also, though, not very apparent in this presentation, but the deeper you get into defined benefit plans, the more you understand this, is that small businesses are often owned by multiple, by multiple partners out there today, and oftentimes we have to allocate costs among different owners. And if we're thinking about professional organizations, law firms, medical practices, that's real common that each professional constitutes a profit center, so to speak, within their business. And cash balance plans provide an easy means for allocating costs among owners and from an accounting perspective. So cash balance plans pair or partner well with 401k profit sharing plans. In fact, this is common. This is normal. The first reason is that most of the time your prospects for a cash balance plan already have a 401k profit sharing plan. It already exists for them. Secondly, most of the folks on the audience know at least a little bit, even if nothing more than the terminology of non-discrimination testing. Everybody knows that with profit sharing plans and 401k plans, we have non-discrimination testing, and we have non-discrimination testing with cash balance plans. And when a sponsor has both a defined contribution and a defined benefit plan, we aggregate those plans together for testing. And the testing is easier when a client has both. We often get asked, well, can they just have a cash balance plan? Because we see large amounts of money going into that and forget about the 401k plan. And the answer is yes, but it doesn't work as well. And that's because having the 401k profit sharing plan helps testing. And down at the bottom of this screen, it's real simple. When we're doing non-discrimination testing on these plans, we can either test them on a current contribution basis or on a future benefit basis. We always want to test on a future benefit basis because that's what gives our owners, especially our older, higher paid owners, more leverage. And when we're testing on a future benefit basis, we can use a higher rate of return assumed in our testing on the 401k profit sharing plan than we can on the defined benefit plan. So why does that matter? Well, think about it. If we've got employees, we can give them more benefit in the 401k profit sharing plan for less money because we can assume a higher rate of return. Conversely, we can give more money to our owners if we nudge most of their benefit to the defined benefit plan, to the cash balance plan, because we're using a lower rate of return there. So lower rate of return means higher contributions, higher rate of return means lower contributions, and that's why we want the two plans paired together. We're going to talk about this when we get into our case study. Small employers have frequent turnover. And so I mentioned a second ago about our testing. And I mentioned earlier how younger, lower paid employees in small business in the U.S. today helps our testing in this example. Well, we also have turnover problems. We have people who come and go. We were working on a case just yesterday, and the plan passed testing, but it only passed testing based on 2 younger employees who had only been with the firm for a couple of years. And so while we were trying to manage the employee contribution made by the employer to as small a number as possible, again at the request of the employer, it wasn't going to work long term because there was a high probability that those employees might leave. And we're going to illustrate that in just a minute here. Also, small employers might have fluctuating revenue or cash flow. Cash balance plans are defined benefit plans, and defined benefit plans have minimum annual funding standards that have to be met. I was asked one time by a client, what happens if I don't have the money to put into this plan next year? And I said, you have to go to the bank and get the money. Because once a benefit has accrued it has to be funded. I got an email from an advisor just a few weeks ago who asked the question, when can a cash balance plan be frozen? Frozen means that no new benefits accrue. And I said, well, a cash balance plan can be frozen at any time, but if a benefit has accrued for the year, it has to be funded. So where a profit sharing plan allows an employer to not fund it up until the last minute, a cash balance plan, once an employee has accrued 1,000 hours during the plan year, they've accrued a benefit, and the benefit has to be funded. So again, I think that a case study helps give us context and something easy to relate to. So we have a small business. We have 2 owners, and one of them has a working spouse in the business. They have 5 other employees who are all non-highly compensated employees. The owner wants to maximize contributions while controlling the overall plan cost, and this is what our census looks like. And notice, if you will, while we've got 5 other employees, we've got a couple of them down here who are ineligible, and they're not eligible because of in this particular plan, we're using age 21 and a year of service, and so we've got some people that don't meet that criteria. So we're effectively going to have 3 owners and 3 non-owners in this plan. Our spouse up here is effectively an owner, and so we have 3 owners and 3 non-owners. And pay attention down there here, if you will. So we're going to talk about this a little bit later. So we have considered earnings in this plan. Excuse me, this plan of $680,000 a year. And like most potential clients that you will run across today, this employer has a 401k safe harbor match plan. Pretty typical. Our key owner and his spouse are deferring $24,000 a year. They're deferring up to the catch-up limit. Our other owner is 49 years old. They're not catch-up eligible. They're getting their safe harbor match based on their wages and their contributions. And so probably the easiest thing to look at is down here. I like this bottom corner here. We have an employer who is putting in $69,200 of company money, if you will. This number does not include the owner's deferrals. And those 3 owners are receiving almost 91% of the total benefit. Really efficient plan, but some limitations on the total benefit to these 2 and the amount that this person can receive. So you're sitting at lunch and you're talking to them about this, and they say, well, you know, gee, I'd like to put away more money. What could I do? And if you look, well, there's no profit sharing going into this plan. So let's talk about that first. You know, step number 1, maybe let's consider a profit sharing contribution. So we could add and this is a new comparability profit sharing. As you notice, we have different contribution percentages going to each one. And the criteria for this analysis, folks, was real simple. First, I wanted to max this person out. And then everything else fell from that. And I wanted that person, or I wanted my my other owner to receive. Here, let me erase that. It's a little bit easier. I wanted these 2 to get the same amount, or roughly the same amount. I came close. So that's why we got 2 different profit sharing amounts here, but we've got 7.1 and 7.1. And then what happened, I arbitrarily gave the spouse 5%, and that dictated everything else. So curiously, in this example, where we've got a match, and this is a safe harbor match, and we've got a profit sharing contribution, what do we have? This is kind of curious. We've got employees getting more profit sharing than owners. But we still have a pretty efficient plan. We still have almost 84% of the employer outlay going to the three owners. So this is something, this right here is something that, excuse me, your owner might complain a little bit about, but you can point to some efficiency down here in that they're still receiving quite a bit of contribution. So what can change? Well, we can change from a safe harbor match, excuse me, to a non-elective safe harbor. And what's that let us do? Well, pardon me a second. Well, what that does is that lets us reduce the amount that we're giving to employees. Now, coincidentally, because we don't have the match, we could have increased the profit sharing up here a little bit, and we didn't do that in this example. Suffice it to say, we would still come back and max out our key owner, and that might nudge this 4.0 up to 4.1 or 4.2. The point is, there's efficiency in the 3% non-elective safe harbor that you don't get in a safe harbor match. In this previous example, all of our non-highly compensated employees are deferring, so they're all getting a match. But that doesn't happen in every case, and we know that. So there's efficiency to be had in going this way, and oftentimes we can reduce our overall contribution. So we've gone from the match in 8% to a 7% profit sharing, and we're at 83% here. And now your business owner says, yeah, but I'm really killing it. I really need to put away more money, and this is why so far we've talked about defined contribution plans, and I know you're here to talk about cash balance plans. So let's talk about cash balance plans. So in this example, now you're seeing what I like to jokingly call serious money. When you're talking about an employer, a business owner, being able to contribute $300,000 a year towards their retirement, now we're talking about serious money. I guess I just sort of covered that up. Let me erase that so that you can see it better. And now we're talking about some pretty serious money for this other owner as well. Notice here again, I equalized this. Now over here on the cash balance side, I didn't equalize the contributions there. I could have pulled, if a business owner said, well, we're not equal owners, but we're close. I want these to be more equalized. We can do that. There's 10 years difference between owner A and owner B, and so I think it's justifiable that we're showing how far this can be expanded with our key owner here receiving the bulk of this money. Still, when we look down here, now we're talking to a business owner, and we're talking to them about contributing, $400,000 and some odd a year. To say nothing of the fact that let's go back here. We know that most of our business owners are what? Most of them are sub-S corporations, and many are not paying themselves $270,000 a year. A lot of business owners are paying themselves a smaller salary and taking S distributions. S distributions are not considered earnings for retirement plans. So there's a lot of conversation in a plan like this, and oftentimes it will involve the client's CPA. And the surest way to involve a client's CPA is to talk about tax savings. So if we have any CPAs in the audience, in advance, I'm going to say that we're not practicing CPAs, obviously, and we're not giving tax advice. We're demonstrating tax savings inside a bubble here. And so, but what we're looking at is this number, and by the way, and I know it's different from the last page, this number is actually the employer contribution. It does not include any deferrals. And the previous page, when I was looking at employer costs, we actually had employer deferrals added into that. But here, you can think of it this way. In a 34% tax bracket, you've got an employer writing a check, so to speak, for $390,000, and with an estimated tax savings in a 34% bracket of $132,900, so they have a net after-tax cost of $257,983. But again, if the owners are getting that much of it, then this is essentially 142% return on that. And that's why a CPA should be involved. We don't know all of the other things that are going on in that client's tax world. Again, this is in a bubble of just talking about the cash balance plan, but it's pretty compelling. So when we're having that conversation of should we increase income and pay more, Social Security and Medicare tax in order to get this, I don't know. That's a conversation that should include the CPA. CPAs oftentimes help our S Corp clients, suppress their wage subject to employment taxes so that they can avoid paying more Social Security. Maybe it's time to not avoid that so that you get big deductions like this. And then too, when we're talking about building some contributions like this, cash flow has to have some stability, doesn't it? So that our clients can continue to fund this, because as I said, once a benefit has accrued, it has to be funded. The plan passes all of its appropriate tests, and I'm not going to go through each test individually. Here it's just kind of curious. We're all used to 401k profit sharing plans where any employee that works a year of service and 1,000 hours at the longest is at least eligible. In a cash balance plan, we have to provide benefit to the lesser of 50 employees or 40% of the population. And in this example, everybody's participating, but not every, and we have to, participating means that we're providing an accrual rate more complicated than we want to get into today, of at least 0.5%. Notice that our 49-year-old employee is not getting an accrual rate of at least 50%. So these folks are effectively covered by the plan, but that's okay. It still passes testing. I do want to skip, though, to this page, the rate group test, just because it's something that I brought up earlier. When employers have fluctuating employee populations, excuse me, and I said younger employees help them pass testing, you'll notice that we're passing here because we have one person with accrual rates that are higher than this owner's accrual rates. I know I just covered it up. I'll erase that so that you can see it. But the point here is that if our 29-year-old terminated next year before a benefit was accrued, then what happens? Now all of a sudden we have to give at least this person enough contribution to bring them up here. And folks, that's a lot of money. That's a lot more money. It's actually only one person. So it's a lot more money than the employer was planning on when we showed them the illustration before. So this is why these plans have to be managed. They can be complicated. And that's kind of the point that I wanted to make with that. Now, to the back of the napkin idea. I like back of the napkin ideas. Kind of an urban myth. I think it's true. I've read that it's true. 1966, Roland King was having lunch with his attorney, and he drew the prospective routes, airplane routes between Dallas, Houston, and San Antonio on a napkin, and made a pitch to his attorney that he was going to start an airline that a year later became Southwest Airlines, and that was supposedly done on the back of a napkin. When you're sitting with an employer, I think you can have this conversation where you can come up with right now they have in this example $680,000 of considered earnings, and you can figure out while you're sitting there how much of that is owners and how much of that is employees. And given the numbers that I gave you, you can kind of look at it this way. First, you've got to pass, in order to make a combination plan work, the first thing you have to do is pass safe harbor. And the most efficient way to pass safe harbor is a 3% contribution. And then you're going to use profit sharing. And what you noticed in the profit sharing is that we gave, back in that most efficient example, we gave 4% in profit sharing. And actually anywhere from 2% to 6% is typical in the amount that you have to give employees for profit sharing. It might be worth noting that between these two, you have to pass a gateway test that's almost always going to be at least 5%. Pardon my scribble. So in the example we gave, so now we're up to 7%, and so 7% of this is 11,200, and then we added the cash balance in, and cash balance, if you wrote it down, or these slides are available, we'll get them to you if you'd like them, was at 2.4%. So if your employer is prepared to spend anywhere from 9 to maybe 12%, and in this case we ended up with 9.4%, and that equaled, I think in our most efficient example, 15,200. Then you can you can make an awful lot of contributions towards the owners. This is the kind of thing that I think an advisor could practice, could have prepared. You can have a conversation at lunch before you collect census data and get into anything too formal. You can query your client to see how serious they actually are, and if this bothers them, if they're not up for this, somewhere between this and 15%, let's say, then maybe this is not the right thing for them to do. Maybe they should be doing something else, with their money. But that's my back of the napkin idea that I think is useful when you're, when you're sitting with a client. We've got, let's see here. Open up my. Sorry, folks. I'm opening things back up just so that I can see any questions. This is a little bit about Pentegra, obviously. If you're not familiar with us, if you haven't done business with us before, we've been in business since 1943. We're one of the larger TPA organizations in the country, verging on 300 employees and $12 billion under administration. And I guess that's my last slide. I can't get to my next slide. So let's see, questions. I have a question that says, I noticed that the profit sharing appears to be new comparability, and you talked about new comparability. What if the profit sharing isn't new comparability? The answer is it needs to be. It might not be new comparability in the first year. There are ways that you can amend during a plan year. There are times at which you can amend during a current plan year. There are rules that surround that. So if you've got a client, if you've got somebody that that doesn't have new comparability, it can work in the first year. It might cost them more money, but it can work, and we would almost always recommend that they amend in the second year. Let's see. Trying to scroll up. Impact of variable rates of return on contributions to CB plan. Can I have an age-weighted profit sharing plan with safe harbor 401k and cash balance plan? If you're going to have an age-weighted plan, you might as well have a new comparability plan. You've got more flexibility. Instead of having you have less control over rate groups. And remember that in an age-weighted plan, you're essentially treating all 59-year-olds equally, all 40-year-olds equally, and so on. In the example we gave, we had a younger owner, age 49, and a non-highly compensated employee, age 49. So in my example, we were able to treat them with different profit-sharing contributions. If this were a true age-weighted plan, we wouldn't be able to do that. We scroll back. For some reason, my having trouble reading this on my screen. We might have to get back to you with the variable rates. Variable rates are a deep conversation, and be happy to have that with you at another time, or maybe we'll even launch another program at another time to do that. But we're coming up on our time here, and it would take a lot more than 3 minutes to go through the implications of using variable rates in a cash balance plan. Not the least of which is that we're all looking forward to moving to prototype documents very soon. And we already know that variable rates are not going to be included in prototype documents. So we've been using individually designed documents forever. If you want to use variable rates, you're going to keep using individually designed documents until at least 2022, because we're not going to have a variable rate choice inside of a prototype document until after that date. One more question. I've heard the plans have to be covered by insurance. Can you explain? I think the question is probably about PBGC, government insurance. And the answer is not always. As a general rule, all defined benefit plans are PBGC covered plans unless they are specifically exempt. Common exemptions are owner-only plans and professional employer plans with less than 26 active participants, and there's a list of what are who is a professional employer. You can think physicians, dentists, chiropractors, optometrists, lawyers, anyone in the healing arts, public engineers, architects, draftsmen. Interestingly enough, performing artists. So if you have a theater troupe, those are performing artists, and they are PBGC exempt. So it's kind of interesting. I think that our time is up. Thanks everybody for joining us today, and we appreciate your attendance. And please let us know if we can get back to you with more information.